How are you doing? This is David W. Williams, also known as Diamond Dave. And what we're going to talk about is, should high performers accept average market returns? And the reason why we want to go into this particular topic is because one of the things that I want to try to help people with is to be able to put themselves in a better position financially. I'm not a licensed financial advisor. I don't have a background in finance from a professional or formalized education standpoint. But what I want to try to do is empower people to start seeing the benefit of making more money. And one of the things that you deal with making more money that a lot of people don't talk about is that you now are expected to accept average returns in the market. And I think because a lot of people are not in that position, it's not something that's often discussed to people. And then when it comes up in their life, they may not necessarily know how to handle it because they never had the discussion. I was talking to some people about the Bruce's Beach situation today with a member of my family. And one of the things that we were talking about is that many people, when it comes to getting a return on capital, when it comes to investing, things of that nature, is that often we don't know what we don't know. And so this was something that I dealt with where, let's say, maybe 07, 08, I didn't know what I didn't know about the markets. And therefore, I could have had a certain amount of capital in front of me. And because I didn't know what I didn't know about the markets, because I didn't have experience, I could have put myself in a bad position because I didn't know what I didn't know. And one of the things I want to try to get people to understand is that as you start to grow income-wise, right, you want to have a better understanding of what type of scenario investment-wise, based on risk analysis, your horizon, things of that nature, is going to be appropriate to you. But we're going to go a little bit deeper because I want to kind of understand the deal that we're being told to take, right, as people that are looking to get more income out of this society. So we're going to use a Tom Brady FTX situation as an example. But his example is going to be kind of extreme, but we're also going to talk about how we can relate this to the average everyday 9-to-5 person. Because one of the things that I want to do is get you to understand that it can benefit you a lot and it can benefit your group and your family to bring in more income. But oftentimes when you bring that more income in, because of maybe what you've had to do to make it, you're now being asked to take a different type of, you're asked to put on a different personality when it comes to getting a return on the income. And we're going to kind of go into that. So let me kind of show you what I'm talking about, right? So here's this issue with Tom Brady and FTX, right? So we know that FTX failed. We know it went under. Everybody knows that story. However, many people were not aware or may not have been aware that Tom Brady was one of the biggest promoters of FTX, but he also had ownership in the deal. Now, what often happens with a lot of people that have a lot of money, they're celebrities, they have really powerful, robust networks, as they get to be early investors in a lot of startup deals. And this is one of the benefits of being a celebrity. Shaquille O'Neal's been involved in this. There's a brother who used to play for the Pistons named John Sally. He's a vegan. He very much promotes that. He was an early investor in Beyond Meat. He was able to get out of that particular deal with a lot of profit. What's the guy's name? Peter Thiel was an early investor in Facebook. He came out of that deal with literally hundreds of millions of dollars. There's a guy I used to watch on YouTube. He was an early investor in Coinbase. When Coinbase did a direct listing, he was able to cash out. He took a few $1 million investment and turned that into hundreds of millions of dollars. When you're net worth in with the right people, when you have a level of celebrity, you often get invited into be an early investor in a lot of startup deals, many that won't work, but some that do work can really expand and increase your net worth. And so this was something that Tom Brady was invested in the FTX. He wasn't the only one. There was institutional money in this deal. We know now that the deal went under. But we talk about, right, with this particular deal, Tom Brady owned around 15%. I have it around 14%. According to assumed dilution and subsequent funding rounds, his ownership would have been around 14%, and his wife had around 8%. They said Brady's stake would have been around $45 million based on the dilution and what he put in, right? And so you want to understand is that Brady was an investor or early investor in this particular deal, which was speculative, right? However, if it would win is where Brady thought it was going to go, he could have maybe took that $45 million and turned it into $1 billion, because people were very, very bullish on FTX. Before all of this fell under, they were saying that Bankman-Fried was going to be the JP Morgan in the crypto space. That's how people was positioning him. We saw that he was positioning himself politically. He was making all the right moves, and what he was doing wrong behind the scenes is he was playing with the investors' money and making a lot of bad decisions. But on the front end, he was making all the right moves. And that's what I want people to understand, is that many times if you are in certain networks, you can get in these early stage deals, and if they go right, they can take a 2 or 10 or $30 million investment and they can turn it into hundreds of millions of dollars. And the average person does not get access to these type of deals. They get access to the IPO, and all my savvy IPO people know is that's when everybody exits and they get retail to come in. So this is one of the reasons why Brady was promoting this, because not only was he promoting it, but he also was in this deal himself. And he had a large piece of this deal. And this is his family's money, right? This is money that he can be taking care of his children, take care of his grandkids. But what he's trying to do is expand his wealth in something that a lot of people will call speculative or risky. And we're going to kind of go into that, right? Because you got to understand what about this particular deal was attractive to Brady. And so that's one of the first things we want to understand. So first, Tom Brady had around a 14% position in FTX, right? The question you want to ask yourself, right, is why would a person worth around $200 million invest in this really, really risky venture? Okay. Why would a person want to do that? And so these are the kind of questions, because what a lot of people will get advice is once they get to a certain amount net worth wise, is what they will be told to do is to look to make sure that they don't lose the money, right? And I also agree with that. I agree that if you work your way up to a certain level wealth wise, the goal is to protect the money, not lose it. And this is why you see a lot of wealthy people go into hedge funds. I got a hedge fund video on the channel. Took a lot of time to produce that video. I would encourage you to look into it. Many wealthy people go into hedge funds for that reason, to hedge against a loss of their wealth, not necessarily to try to make more money. And you would ask yourself, a guy that's worth $200 million, he can just sit back now. There's no reason to do anything else, because a $200 million net worth, that should be able to generate a return to maintain your lifestyle and to keep building up that principal over time, where your great grandkids will never have to work. So the goal is not to lose the 200 million, as opposed to how to expand it. So why do you think he would do that? And we want to kind of talk about that, right? So you want to understand, why would he want to get higher than average returns? Now, we know all the places to where you can go put your money and get an average return. Why would that not be appropriate for Tom Brady? Because that may be the counsel he would get. You're worth $200 million. You can just go stick your money in these specific places and you can just go get average returns. Why do we think that would not be attractive to somebody like Tom Brady? Because that is the advice we would get. Just take your money, put it into an index fund, put it into some treasury notes, maybe put it into some, traditional real estate plays, and just go get an average return and you're good. And the average person would think, well, that should be appropriate for Tom Brady. But the question you want to ask yourself is this. Tom Brady is an outlier professionally in a field that pays people at the top millions, right? A lot of people that play NFL football don't make millions. The guy that just got hurt playing for the Bills, he wasn't making millions. There's a lie that everybody making NFL football makes millions is false. You can go actually look at the salaries of the teams. He's an outlier professionally in a field that pays the top people a lot of money, right? And what you have to understand with a guy like Tom Brady is that why would Brady risk paralysis, death, injury, and it change his personality as an investor? So we know Tom Brady years ago, he was playing the Chiefs, blew his knee out, right? He had to come back from that. We know that now because of a lot of research, a lot of football players are risking CTE, right? That's a risk that he's taking. We know that you can die playing football. We just seen that with a guy earlier. You can die playing football. So you're risking all this, and he's been risking this since around 2000? Early 2000, 2003, 2004, playing for the Pats. He's been taking these risks and he's been successful. Okay. So this is his personality. He operates in a profession that is extremely high risk. There's an extreme amount of danger in what he does. And he's figured out how to successfully navigate that for a long period of time. And this is how he's made his money. Tom Brady didn't make his money behind the desk, right? He didn't make his money, talking on YouTube. He made his money in a very high risk professional environment that's very cutthroat, right? In which people are churned in and out every year. And he was fortunate enough to be extremely successful in that environment. The question I want to ask is, why would he therefore then, as an investor, change his personality? Because he's an outlier. So here's one of the tricks of the NFL. You're not vested in any of their programs until you do around 4 years. Well, what do we know? Most NFL players don't last 4 years. Therefore, most guys that get drafted into the NFL aren't going to stay around long enough to get vested in any of the programs. Tom Brady is fully vested in all the NFL programs, and I'll put the link in the chat. He's fully vested in all those programs. He could have just took advantage of those programs, right? But you don't last this long in the NFL unless something is different about your personality. And then why not, as he moves into the investing space, why do we believe that his personality would all of a sudden just change? And so these are the kind of questions we want to ask ourselves, because he's an outlier as an NFL player. Why would he not be an outlier and have a different perspective on risk than he would have in any other situation of his life? Because why? He made all his money in a high risk environment. And that's what I want to ask people. So I don't look down on him for putting money in FTX, because why? Based on his lifestyle, an early investor in FTX may have made sense. Okay. High risk, high reward. Same way he made his money in football. Tom Brady did not make his money in football as a coach. He didn't make his money in football as an announcer. He didn't make his money in football as an analyst. He made his money on the field. That's how he made his millions. Right? And then he took that and was able to put that into different vehicles, but he made his wealth on the field. And it takes a lot of risk to do that. And the average person, they may think they want to take those type of risks, but when you put them out there on that professional field and then people start flying around you at 100 miles an hour, they would realize they don't want to take those type of risks. I seen a play, I want to say maybe 3 weeks ago with Russell Wilson. He took an extremely violent hit trying to get a touchdown. The average person would take that hit and decide they done playing football. And that ain't the first hard hit I seen that guy take. Right? These men are risking a lot to make this money, to be employed in this particular area of their life. And we would ask ourselves, well, why, when they're done in this area, would they all of a sudden now turn into a different person if they were comfortable taking this type of risk to make their money in the first place? Okay. So to me, it's appropriate that Tom Brady would invest in a speculative early stage crypto deal that, you know, it could be a boom or a bust scenario, because why? That's how he made his money his whole life. And because he may not be satisfied with a $200 million net worth, his attitude may be, it's worth the risk, because why would Tom Brady be cool with a 10% or 8% return on capital? Okay. Why will he be cool with that? And so this is what a lot of people want to understand. Let's look at the returns on a rate of return on capital. It says if you're investing, this from Investopedia, a 401k plan can provide an average return of 3 to 8%, depending on how you allocate those funds. Okay. Average rate of return of the S&P is around 10%. The question you want to ask yourself is that, why would Tom Brady be content with an 8 to 10% return? And that's not even factoring in a rate of inflation. Why would he be content with that? I'm not saying there's anything wrong with getting those rates of return. I'm saying based on how he made his money, the environment that he's been successful in, the risk that he's had to take. Do you sit down with Tom Brady and tell him, I'm going to get you an 8% return? Well, you know what? That's the same return that a guy that's doing cashier at Walmart can get. Why would he be content with that? Now, you may say, well, you're able to put more money in it, but the return on capital is going to be the same. The way to get the really extreme gains in return on capital is to take on a lot more risk in these speculative type plays, right? So therefore, FTX went under. What we talked about with Nas. Nas was in Coinbase. Coinbase didn't go under. Nas was in Ring. Ring didn't go under. But we don't know what else was in Nas's portfolio that didn't go the way Coinbase and Ring went. Because many times when you're a venture capitalist, you're an angel investor, you have a portfolio of companies that you invest in. The majority of that portfolio doesn't do well. Your belief is that the ones that hit are going to be such big home runs, they're going to cover the losses, and you're also going to put yourself in a position to make profit. And that's often how early stage investors look at their investors. But you want to ask yourself, why would somebody like this, that's an outlier in his profession, take average returns? Because he could have just stuck all his money into the NFL 401k. And because of the amount of money he has, he would have a nice return on his capital, but it wouldn't be greater than the average return on capital, because most likely they're just going to stick it into an index fund and charge him a management fee. And so these are the kind of things that I want people to start asking themselves, because we're going to now apply this to the average everyday 9-to-5 person in our society, right? So let me show you what I'm talking about. So let's take a look at the average person, okay? And we're going to look at just the regular person in our society. So there's the regular person, right? So these are some people working at a theme park at Universal, okay? And so really quickly, so one of the ways in which we've been able to get a higher rate of return than most people is something that we call getting alpha out of the market. Is one of the things that we've been able to do is become options traders, right? And so it doesn't work for everybody, but one of the things that I enjoy about it is because I'm able to not only get my average returns, I'm able to get a higher return on capital than the average person by managing my risk and understanding what I'm doing. It puts me in a position to where I won't be trapped in how much money I make per year at a job. I don't necessarily have to try to figure out how much time I got to take away from my family to make the money, and there is no cap on my income. So you can learn more about that by going to www.thehighestpaid.online. That's an options trading academy. It's been successful for a lot of people, but that's something that has worked for me and some of the people that I've worked with. It may work for you, but it's something that you would want to look into, because you got to always ask yourself, if I'm an outlier in what I do, why would I only accept an average return on capital? Now let's go back to the average person, right? So I'm from a city where there's a big tourist industry. There's a big service industry, right? And so we're going to look at like the average person in my city, okay? And kind of look at their situation. So we know the average median income in Orlando is around $40,000 a year, right? So I just pulled this up. This is from Data USA. Median earnings by industry. Median earnings in Orlando is around $39,000 plus or minus $2,400. That's for men. Median earnings for women in Orlando is around $30,000 plus or minus around $1,000. Okay. Been telling people for years, if you can pull around 60 grand a year in Orlando, you're balling. You're balling. In the city that I'm from, it does not take a lot. Now the real estate market is skewed, but for a very long time, the money I'm making now, if I was living back in Orlando, I'll be balling if I owned a home. I'll be balling. If you're renting, you're going to have to deal with the rent market. But if you're already a homeowner, you can get above 60 or above in a city of Orlando, you're balling. Why? Because of the service sector, there's not a lot of people making a lot of money. It's just how it's set up. Okay, so let's take it back to the average person. Average median income in Orlando was right under $40K a year. Okay, so this is average. No, everybody on the internet is doing six figures. We're actually pulling real city data. Okay, if you go pull the census data, it's going to be around 38 per capita income per person. Women don't make as much as men. Now, we know all the women on YouTube, especially the black women in that little sector, they want to tell the story that they make as much as men, but we keep showing data that women on average in most cities don't make more than men for a lot of different reasons, okay? Let's say you're living in Orlando and you start bringing in $100,000 a year. You're now an outlier. Now, what we're told with our 401k is to retire as a millionaire in 25 to 30 years, you need to be putting around 50K in there a year, right? So let me ask you a question. You're making 39 a year. How do you put the 50K in to the 401k to retire in 25 to 30 years with $1 million? How is that possible? So I can go to the city that I'm from and we can pull the average person out of our society, and their income is going to be around the median income of that person that we just pull out. It's going to be around $40,000 a year. How do they get to the million for the 401k if you got to be putting around 50K a year for about 25 to 30 years? That's just to get the million, right? Therefore, what can we, I don't know if the proper word is deduce, but what can we infer is that the average person in Orlando, right, based on the income, unless they're married and they're doing a joint effort, but the average individual unmarried person will not be able to contribute to their 401k to hit that million until they can become an outlier income level. Because if you can make $60,000 to $100,000 a year in Orlando, you're an outlier. But if you can make over $70,000 a year pretty much in any city in the country, you're an outlier based on income. Right? So what do we mean by that? You now have outperformed the majority of your contemporaries. Right? So we talked about before, you have to be an outlier in Orlando to have the 50K to put the 401k in on a yearly basis. If you're going to stash away 50K every year in that 401k, you have to be an outlier in the city of Orlando. You can't just be with the group. Okay. Now, the question we want to ask ourselves is that what did you have to do to make the 100K a year? Many people that are leading their job and income, they've had to outperform their contemporaries. Let's say you work in sales. You had to be the best salesperson, right? Let's say you work a job and you moved into management. You had to be successful hitting your management metrics to make that money. Let's say you work in retail. You got to open and close that store. You got to hit all your sales numbers to make sure you hit your bonuses. So you've outperformed not only your contemporaries to move into management, then you're outperforming the other stores in your territory or your district. Okay. Let's say you work in government, you got into leadership positions. So you outperform your contemporaries. Therefore, to get to that income level, you had to do things that were not normal to the group to become an outlier in the group, right? Because you're not normal, you're abnormal, or you're outside of the norm based on what you had to do to make the income. So what do we know about you? Your personality is different. You're not the average person in our society, because the average person in the city that I'm from, they're going to just take the $40,000 a year and they just going to chill. And they're going to enjoy the sunshine. They're going to smoke. They're going to drink. They're going to have sex. And they're never going to figure out, what can I do to change my life? They're going to just fall in with the crowd. What is the crowd doing where I'm from? They enjoying the sunshine. They're making a 40 grand a year. They on social media and they smoking, drinking, and having sex. And that's just what everybody does. So you're not abnormal until you decide that you're not going to do that. If you do that, you just falling in with the crowd, right? So to get to the $100,000 a year, you have become an outlier. Well, that says something about your personality, because you haven't adapted to what the group is doing. You aren't moving with the crowd. You're moving away from the crowd. Question you want to ask yourself: why would you accept average returns when you're not average? So this is the way the situation works. Why would you accept average returns when you're not average? I've shown that I can perform at a higher level to demand more money in this marketplace. I've proven that. Whether I work in sales, I work in management, right? I'm in a leadership position in government. I've shown that I can operate at a higher level to bring more money into my situation. So the marketplace values me at a different number than it values the average worker. Then when I go out into the marketplace to get a return on my capital, what I'm being advised is I should just take average returns. What that doesn't meet my psychology, because I'm not the average person. Okay. We talked about the 401k average returns around, what was it? 8%, 8 to 10%. S&P get you around 10% on average. Now that's not bringing in inflation. Once you bring inflation in, those returns are going to get a lot lower. And that's one of the reasons I always tell people, when you're talking to somebody, they're telling you that this is going to be the rate of return over the next 20 years. Ask them how they factored in the projected inflation rate over the next 20 years. Because we're going to get a CPI print next week, and we want to see what that is. But currently the CPI is at 7%. So that's eating into your return. So if you're dealing with an advisor and they're not factoring that in, either they're purposely omitting information from you or they just don't know. But we're in the market. We're looking at the rate of return at plus the rate of inflation all the time, right? So what funds have done, in my opinion, is they've created an annuity back to their company using their clients' money. This is a very, very sophisticated, I would call it a con, but it's a very, very sophisticated scheme that they've created, these big funds, right? Because everybody is against active management. What do I mean by that? We're in an era that we were in for a very long time, is that you just stick your money into an index fund and you just let the index fund get a return on capital. They may rebalance it, but they're not actively managing the money. That was considered to be too difficult to be successful at. So then everybody said, well, just stick your money into an index fund, a passive fund, and take your 8 to 10% every year. Okay. Here's how this annuity system works that these funds have created. Okay. And let's go to the picture of the funds real quick. Let me go to the funds. So that's the fund managers, right? They got a real tight scheme going where that becomes an annuity back to their company, right? Because of the way they're operating this scheme, right? Here's how it works. So you're the regular person in society. You work at one of the theme parks in the city that I'm from, right? Work at one of the theme parks, just a regular person. So you invest in the fund's 401k. Okay. Fund pays a management fee to put your money in the index fund. You're paying the fund a management fee to put your money in a fund that mirrors the S&P 500. Now you may get matching money from your job to do that. What you may not know, and I may do a video on, and I may not do a video on, because I got to figure out the time it's going to take to do the research, the compensation level. But what you are not aware of is that if you work for company XYZ and there's a 401k attached to it, that organization that is sponsoring that 401k, they paid your company, right? They paid your company to be able to offer that 401k to y'all. As a result, your company gets paid to put that 401k in front of y'all. Then the company that sponsors the 401k, they get paid in the 401k to manage your money. And all they're going to do is stick it into an index fund because we're in the era of passive management of capital. Nobody wants to pick stocks anymore. We just want to take a fund, mirror the S&P 500, but you're paying me a management fee to mirror the S&P 500, but you're cool with it because why? If I put in 4%, my job puts in 4%. And then the management fees and the taxes get taken out on the back end when you finally exit the fund at 65 or whatever year. That's when you got to pay the fee, right? But that's all they're doing. They're not picking any stocks because that's considered too difficult now. So now you just put it in these passive funds, or they pick Apple, this tech company, yada, 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 pick like 8 tech companies that are really, really blue chip, and they create an ETF around that, and they just rebalance that every 6 months, and you're paying for that type of management. This is what's going on now, but you're paying them money to do that. So they're just indexing your money, right? They're just indexing your money for you. They're not really doing anything because they're not picking stocks, right? They're just picking the S&P 500, okay? Now the fund, let's say hypothetically has 5,000 or 500,000 clients in that fund. So company XYZ has 500,000 clients in that fund. So I used to work for a major healthcare corporation. We had about 10,000 people working there. And then we had one of the major fund companies that had their 401k attached to the corporation I worked with. They had to have at least 3,000 or 4,000 people in that 401k. And they're all over the country. So they can go to every major US market and pull 3,000 to 4,000. They have 500,000 clients in that fund easy. Okay. This becomes an annuity back to the fund. Why? Because it's just a subscription model. You're paying them to manage it, whether they get the money quarterly, annually, biannually, or they get the money when you exit, they get paid either way. So it becomes now a game of volume. How many people can we get into this fund? And they do very little work. And then what they condition the client to do is accept average returns. You've been conditioned to accept an average return. But let's say I'm working for this healthcare corporation, and I become like a floor manager or a department manager. I'm making $90,000 a year. I broke my neck to get this job. I worked overtime. I went back to school. I educated myself, right? And now I'm making $90,000 a year in Orlando, which is a lot of money to make in Orlando. You make $90,000 a year in Orlando, you balling, especially before the real estate situation we had over the past 2 years. 2015, 2018, you bringing back $90,000 a year in Orlando, Florida. You got a house out there in Lake Nona, man. You balling. Like you getting real money out there. That's big money for Orlando, Florida. Not big money in Miami, but in Orlando, that's nice paper. No state tax in the state of Florida. You're doing real well for yourself. So you have outperformed your contemporaries to get the management position to make 90,000. But your job is telling you just accept 8 to 10% a year. So now you got to put 50,000 a year in this 401k to get to $1 million in 25 to 30 years. And they want to still get their management fees out of that. But they're not doing anything for you though. But they're conditioning you, just take the average return, because 10% is supposed to be a great return. I'm not saying 10% is not a great return. What I'm saying is that we're telling people that have the personality to outperform their contemporaries, then when it comes to get a return on their capital, they're only supposed to accept a lower return on capital. So if I'm making $90,000 a year because I've outperformed my contemporaries, I'm supposed to accept the same return on capital for my 401k plan as the guy in my job that is a slacker, but he's also in the 401k. See what I'm saying? And so this is what you're conditioned to accept, but you're not the average person. You're not the slacker. You're the high performer. You want your money to perform at a high level the same way you perform at a high level. So then you got to take on riskier situations. Then when it goes bad, like Tom Brady, everybody talks about you, but it don't surprise me at all that Tom Brady invested in FTX, because why? Tom Brady made his money in a cutthroat environment, right? Tom Brady made his money Tom Brady made his money in a game where a DB tries to tackle you in your knee to get you out of the game. And he don't care that that's going to injure you. His job is to get you out of there. That's how Tom Brady made his money. So he's been able to survive all that to get in a position to be worth $200 million. He don't see no risk in FTX. That's not a risk to him. The risk to him is I got to play the Cowboys in 2 weeks. Losing $45 million is not a risk to him. And so I think people are not factoring in the psychology of this environment. And then we're telling people, well, you should just take a 8 to 10% return on capital, right? And so this is why spec funds and early stage investments can always be attracted to people. They're not attracted to everybody. And I'm not saying that you should go into them. What I'm saying is that when you're looking at the Cathie Woods, when you're looking at these type of people with these speculative funds, she was on Twitter today talking about there was a cure for cancer that the media is trying to hide because she's trying to hype up her genome investments. The reason why what she does is going to always be attracted to people, because she's really going after an audience of people that have made their money, right, in this world by being better than everybody else. And they're not going to accept 8 to 10% in the SPY. They won't accept that, right? That's unacceptable to them because they didn't make their money that way. And so there's a market for that audience. Now, I'm not talking about the person that has done nothing in their life and they throwing at this crypto, this Dodge coin or this Shiba Inu coin is going to get them back 300%. I'm not talking about that person. I'm talking about the person in this world that has consistently outperformed their competition in their workplace or in their profession. And they moved up. And they're trying to ask themselves, well, why would I accept average on my investment when I'm not here because I'm average? Because if you're going to put $50,000 a year into a 401k, you can't be average, because we know that the average person in Orlando is making $39,000 a year if you're a man and $30,000 a year if you're a woman. You're never going to get the $50,000 a year to put in a 401k. Therefore, you have to change something about who you are to be able to get in a position to max out the 401k. Once you change who you are to get in a position to max out the 401k, you're going to look at things differently. Why would you take the same rate of return on your capital that the person at your job that has a slacker that comes in late twice a week, right, and don't want to do no work, he can get that same return from the same 401k plan that you're in? And this is what I want people to understand. The funds have created an annuity to themselves with this passive management. It works for them. That's why they don't want to go away from it. They want to keep sticking you into these index funds, these passive management funds. You pay us a management fee. We don't manage anything, right? We're not managing anything. And then as a result, right, you are being conditioned that that's the best your money's going to do. And so what I really would ask you is that get with some people. What I would do, so I can't tell you what to do because I can't advise you on investments. What I would do is get with some people that understand how I make my money. And they understand what kind of personality I had to take on and the kind of risk I had to take to make my money. Because you could be sitting down with an advisor that don't really understand what you had to do to become successful. And some understand is that you may not think it's acceptable to take 8 to 10%. And they may be able to create a narrative for you to maybe get you to better understand why you should, some of the risk, yada, yada, yada. Because if you made all your money taking a lot of risk in business or in your profession, why would you want to sit there and have your money start moving slow? Because you didn't make your money moving slow. You made your money being very aggressive. You made your money taking chances. You made your money outperforming your competitors. And then you're now told that you should just allow your money to move slow for you. There's nothing wrong with having slow growth, but that may not fit your personality. And you may need somebody to speak to you to get you to understand why that may or may not be the best benefit to you. And I think that's what would have helped Tom Brady, right? Now, he lost $45 million based on what we believe that was worth. It don't mean he put $45 million in. He's going to make about $90 million this year. He's going to make even more money when he goes into the booth to talk about football. So he'll get all that money back. But there was no surprise to me that Tom Brady was in a speculative investment around something that he probably couldn't explain, because I know how he made his money. And so this is why when I see professional athletes, and I heard that they went broke, like the brother that played basketball out of Chicago, I think you remember his name, played for Kentucky, played for the Celtics. He's from the south side of Chicago. Cold ball player, right? Really was ahead of his time. He was playing today, he'd be hitting them boys for 25, 30 a night. Cold player, right? And he went broke in real estate. But he made his money, right, being an aggressive basketball player. He made his money with a lot of confidence in himself. He played on a team in college that was stacked, and he figured out in that competitive environment how to actually get on the floor. Because you weren't guaranteed to play in Kentucky back then. Yeah, GC, Anton Walker. When Anton Walker went to Kentucky, it wasn't no guarantee you was going to play. You might go to Kentucky and sit the bench. So he figured out at Kentucky, in a very competitive environment, how to rise to the top, to actually be seen, got drafted, got paid a lot of money, put his money in a lot of real estate deals. They didn't work for him, and everybody talked about the man like a dog. But he don't get to that position if he thought like the average person, because the average person wouldn't go to Kentucky to play basketball because they would be scared they weren't going to play. You understand what I'm trying to tell you? We have to factor this in when we're looking at people and the investments that they made, and understand that a lot of times the moves they made with their money were investments that based around their personality and how they made their money. Everybody don't make their money on a desk somewhere. But there's a lot of people on desks looking at these people, right? And not realizing is that I don't even make enough money to max out my 401k. And these are the kind of conversations that they're not having. To max out your 401k, you have to be outside of the norm in this society. You can't be the norm. But when you get outside of the norm to max out the 401k, you may believe that, you know what, the return on the 401k is not enough money for me to be satisfied with, based on what I had to do to make the money, the nights I had to spend, the time I had to work on my craft to get good. And they telling me I should just take 8 to 10% and be happy to retire with $1 million in 25 to 30 years. That's not enough money. So when somebody pops up and say, hey, man, I got this lemonade stand idea, you may feel like, hey, man, give this dude $250,000 and see if this lemonade stand idea could work, because that can get me where I want to go faster than just trying to get 8 to 10% out of the S&P. Because why? That's how I made the money to even put the money into the S&P. And that's something I think people should consider. So we're going to go through the questions, man. We're going to get up on out of here because I've been here 38 minutes. So I appreciate everybody for coming through. Katrina, what's going on? I appreciate you coming through. So y'all check out this. These are all the programs that the NFL offers to their players. It's very robust. There's a lot there, but you got to be vested, which means you got to stick around long enough to get into them. Yeah, Nas was early in Coinbase, but what do we think he invested in that didn't work? So Coinbase worked, but what else we think he invested in that didn't work? And Nas was able to access those through his network. The average person would never find out about that Coinbase deal. Yeah, Mr. Leary, yeah, he invested in FTX. A lot of heavy hitters was in FTX. A lot of heavy hitters was in that deal. TWI, man, I appreciate the $4. GC, what's going on? JLD, I appreciate you coming through. Alonzo, I appreciate you coming through. So see Steve Young in the business program discussing his VC company. All right, I check him out. So he says Ron Jaworski owns multiple golf courses. Okay, I feel you. I didn't even know they played golf in Philadelphia. I'm sorry, is it Philadelphia or Philly? Thought it would be too cold. Erica, what's going on? Yeah, go big or go home. So most people don't want to have an actual factual conversation on what's really going on. They just want a bunch of sound good finance platitudes. Yeah, I believe you. Preacher says this is gold. I appreciate it. Katrina says put in the Patreon. I probably will. It'll take some time for me to put it together. So those fees cover the customer service questions like what's in my 401k. Definitely. Definitely. And people should ask that. That's something a lot of people don't ask. They don't ask what's in the 401k, right? Because to me, the 401k allows you, in my opinion, too much variety to where you're putting your money down the hole. You don't even know it. And you're still paying a management fee, you know, and the guy that created the 401k said that he didn't create the 401k for it to be as varied, but they know people want more options. But a lot of people are putting their money in stuff. They don't even know what they're putting their money in. And they don't have the money to lose like Tom Brady. They barely have any money. Okay, Erica says, great information. Okay, Eric, I appreciate the support. Some companies lobby to expand annuity. Yeah, I believe that. They want everybody on it because it's easy money. I don't have to do any work. I can partner with a business, pay them to offer this 401k. They match it because it creates stability in their business. Because I've seen people stay on jobs because they didn't want to get outside of that 401k plan. So they like, man, I'm going to retire here because I can't get a better 401k set up than what I currently got right now because of the matching, right? So there's nothing wrong with that. And it's just easy money to this fund. They don't have to do anything because why? We just mimic the S&P 500. You know, all you do is look at what's the S&P 500. And if the S&P, if they rebalance like they bring in Tesla, then we bring in Tesla. It's easy money. And then we just run a lot of marketing to get more people in, right? And then we keep conditioning our clients that all you should ever expect is 8 to 10%. You shouldn't expect any more than that. It's long-term investing. You know, Vanguard will tell you we don't trade the market. Cool. You know, I'm not mad at nobody because, like I said, some returns better than zero, but I don't think the average person knows the kind of money that you got to put in early to able to come out of that in 25, 30 years with a certain amount because of the 8 to 10%. And then we're not even factoring in inflation. So I can't pronounce the first word. So it's clutch. Slow growth is fine for a stable world. The world hasn't been stable since September 10th, 01. Yeah, I mean, slow growth, I think is fine for the person. You know, I wouldn't, if I was a guy like Tom Brady, and I'm not him because the dude is wealthy, I wouldn't mind having a certain amount of my portfolio being slow growth. But like I said, based on his psychology, I don't think it's abnormal that he's in an early stage crypto deal that matches his personality. Right. I just don't think that's abnormal for him to be. You know, he probably 100% believed in the deal, you know. So Katrina says 2.2 million is needed for a decent retirement. I believe that. It'll probably be more in 10 years. Yeah, GC says, yeah, GC, I think he's with that dude. I forgot his name. It starts with an A. So he running with those because one of those guys in that crew is a big fan of hip hop. And I think that's how Nas got brought in. Right. Because that crew that Nas is running with, I think they also put that money behind that black dude that did that. It's like I call it a hygiene company, but it's really like a health and beauty company called Bevel. I believe that's the name of it with the razors. They put money behind that black dude that did that. So they're very much about including black people in that space. It's very deliberate. And I think that's how Nas got included, which is a benefit to Nas. Because sometimes just as a celebrity, because a founder is a fan of what you do, they'll try to put you in the deal. You know what I'm saying? And it can happen like that. But the average person never gets access to those kind of opportunities. Terrence says, I work at a hospital that basically uses Vanguard. Yeah, Vanguard's big. They got a lot of money under management. And I'm not mad at them, but they get money. Yeah, Kathy gonna get that money. If she knows her audience, she knows her audience because she deliberately has marketed herself outside of the norm. Because Kathy knows how to run money. She got a really good education and she's worked for some really good funds. Kathy knows how to run money, but she's differentiated herself with I'm gonna do more experimental speculative stuff as opposed to just mimicking the S&P 500. And so that's her audience. So she got to promote stuff and tell people, Tesla's going to be $5,000 a share. That's what she got to do. And she makes money regardless on the pool of capital. Terrence, I appreciate the $4.99. So Katrina says it's available online. The TSP has like 5 funds. Yeah. Smart Money Chick said most people want to set it and forget it as far as their 401k is concerned. And I can understand that. I just think that's going to be, I think a person putting their money somewhere and don't really know where their money's going. I wouldn't recommend anybody to do that. But we don't necessarily live in an environment where a conversation around real investing and how the market actually works and what's in the S&P 500, how is it weighted, what's in the Dow 30, what's in the NASDAQ, how it's actually weighted. People don't see that as entertaining. And so as a result, they're putting their money in these funds. And like I tell people before, when it makes money, you don't know why it made money. Then when it loses money, you don't know why you lost it. Because the average person don't even know how the market works anyway. We live on a social media where the people, the quote unquote dating market is a catch term. That person can't even explain to you basic supply and demand, which means they don't know how a market works. And I think that's unfortunate. People are involved in something, they don't know how it works. So Katrina says, look at what BlackRock did with the military and TSP expansion. Okay, I'm about to check that out. That'd be something good to research. Okay, so Clutch says, we're told by more legit financial talking heads to live like paupers. What's the point in living if minimalism will be the new standard? Yeah, I mean, that's the narrative that, God made a lot of money. We're not going to say his name. He's made a lot of money by telling people to eat rice and beans for 25 years. And it's considered tough love. And, I forgot the name of these particular type of Christians, starts with a P, like that type of ideology. And it kind of like buys into the American idea of bootstrapping. You're just going to take self-responsibility, yada, yada, yada. But I agree with you. Why would somebody work 40 hours a week, 52 weeks a year, and they can't enjoy anything about life? So essentially what we're telling people is that you're doomed from birth. So your whole life is going to just be hard because you were born into a bad situation that you yourself couldn't get out of because you was born into it. So you should just accept to just have nothing. And then you're going to pay this guy to tell you that. Like people, it's like a really strict diet. Nobody's going to stick to it. Then when they don't stick to it, then you can say, well, it's your fault because you didn't stick to it. But people can't stick to really strict diets. You got to give them a cheat day. But this guy's ideology is that, you just got to eat, rice and beans for 30 years to get out of your financial situation. But nobody can maintain that for 30 years. Then he can say, well, you didn't do what I told you to do for 30 years. So if you miss 1 year out of it, that's his excuse to get out of the deal. But, it is what it is. I'm not against structure and rules and regulation, but you got to always take into account that people need to enjoy themselves a little bit because they people. Who wants to live a life where you don't have no fun? Like, I don't get that, but everybody different. Everybody different. I didn't join the seminary, so I don't know why I got to live like that. Yeah, it's Anderson Horowitz. It's Anderson Horowitz. That's the guy. I thought that's the guy. So he teamed up with, I think, the guy that did Bevel, and also I think he teamed up. If I'm not incorrect, I think also he linked up with Nas. But I know he did the Bevel thing, who I don't hear a lot about anymore. So JLD says, you've been putting your money in the TSP for 4 years. I learned we can switch funds. I feel you. All right, Romeo, I appreciate it. The $10 super chat, man. I'm glad you get some value about it. Reach out to him, Eric. I follow him on Twitter. Right? So reach out to him. I follow him on Twitter. I've been listening to him for a while on his Tesla analysis. So I follow him on Twitter. Been following him on Twitter about a year because he's one of the few Black people in the space that can even get on the big shows. So that's one of the reasons why I follow him. So yeah, bring him on. You know what I'm saying? I respect his analysis. You know what I'm saying? Because now he's shown to be right about Tesla. But when he was talking about it, they was trying to clown the man. But you know, that's the crowd. You know what I'm saying? People are always gonna go with what the overriding sentiment is. All right, man, let's go get it. No, it's the Puritans. I meant to say the Puritans. Because Protestants, I don't know if that's a denomination. So Erica says it lowers the spirit to reduce to nothing for love. Yeah, I agree with that. I'm not against people being disciplined, but I'm one of the things is that you got to let people have a little bit of fun in their life because they're working hard. I would never tell a person that's working 40 hours a week, 52 weeks a year, that they can't have any fun. I don't care how little a bit of money they make, because what it's going to do is it's going to repress it. And then when it finally comes out, they're going to go crazy. So that's why I would never tell nobody to do that. But that's their, you know, it's this very Puritan, you know, the Puritans is women got to wear dresses down to their ankles. You know, if a woman can swim, she's a witch. Like this really kind of weird fundamentalist ideology around everything that works on people till they realize like this is like another form of slavery. You can't do anything. You know, we're not in communist China. Like, why do you want to treat people like that? So James says golf courses are major in the Philadelphia area. I wouldn't think that because of the weather. Because like I'm from Florida, where you can golf year round. So I used to live by a golf course when I was in college. I lived literally maybe 50 yards away from a golf course that was owned by my college, 18 holes, right? So we could golf year round. Like the problem with Florida, it gets too hot to golf. You know, I went out there one time and it was so hot. I say, man, I couldn't believe it. Like it was so hot out there one time. I went out there to just hit some balls. So in Florida, you can golf year round. I wouldn't think in Philly because why? Half the year you can't golf. It's not even good up here in Metro Atlanta. You can't golf all year. In Florida, you can golf all year. In Orlando, Tampa, Miami, I don't think, unless it's raining, you can golf. And Tiger Woods is to golf in the rain. Okay, El Vickers says Bevel was purchased by Procter & Gamble. Okay, that's why I ain't heard about it. Okay, well, big up to him. He got purchased. He got acquired. So big up to him. You know, he'll be sitting back on a lot of money. So Musk was talking about prosecute Fauci, even though he misread science. Okay, you know, it is what it is. Yeah, that was real big on social media. I want to say 2012, maybe 2018. I'm not against grinding, but you got to take some time off and you got to enjoy yourself. Life is short. I just really believe in that. You know, you just can't just, you know, go at it. And if you do, you got to have time planned to take off. But this idea to where you are in a bad financial situation, so you got to take the next 10 years, just, you know, nonstop work, beans and rice. I don't know nobody that can maintain that. It sounds good to tell people that though. But you know, some people they like people to hit them and stuff like that. Like some people like that type of stuff. You know, that's like really what they're into. So I think there's a not only a physical form of what you call sadomasochism, I think that's that term. I think there's a psychological form too, where you want people to like be real mean to you. And you think that's I don't know what you want to call it. You think like that's affection or they interested in you. Like to just be really hard on you all the time. You know, people into that type of stuff. It's just not what I'm into. So Jude says golf season from May to November. Okay, we have Florida's year round. It's from January to December. Pick up again in January, right? Unless there's a hurricane, you can play golf, or it's raining. Other than that, you can play. The problem is it get too hot in the summer to play. But if you can take the heat, you can play. So that's why I wouldn't think it was golf up north. But I'm not from up north, so I wouldn't know. I know down south you can play year round. Yeah, I know where you're so Erica says basically playing breaks, playing dinners that require planning. Yeah, definitely. But at least you put it in. But these people are being told, Erica, to just go, beans and rice, no entertainment budget, because you're behind financially. But then the question is, what's the motivation? Is the motivation 10 years down the road? Like they got to be, like I said, I think some of these people are psychologically into like S&M. They're like in the psychological S&M, not into the physical kind. You know, and it's just this idea that most people don't make enough money. It's really not they spending, they just don't have it. I think they should try to maybe work on making it, because there was this one story he put up where the woman was in like $30,000 worth of debt. She was a nurse and she worked like double shifts for like 2 years to get it out of there. She got it out of there, but she just worked double shifts for 2 years. Like, that's a lot, because I know nursing is hard. It's also psychologically draining. So she had to do that to get out. And that was like his success story. But like, that's a lot. She could have did that easier if she was married. But, you know, he can't tell that. He can't say that. You got to leave that alone. So she had to do it all by herself. Clutch says, I work in a country whose national psyche is about strict discipline, constant grind, suppressing desire. It's how the highest. So, yeah, I know where you're at. And their teenage, I don't know if you can say the word, we'll call it self-deletion rates. Their teenage self-deletion rates are sky high compared to the United States. And it's because they put people under that kind of stress, and everybody can't take it. You know, and it's not that you're a weak person. Everybody just can't take it. You know, you can't do everybody like that. So I know exactly what you're talking about, because I know where you're at. And I know that even before you got there, because there used to be this thing there to where if you didn't pass this standardized test, you couldn't go get higher education. So a lot of the young people that didn't get the marks, they just would delete themselves, because they'd be like, my life is over. So, you know, when we talk about a lot of these really competitive Asian countries, we don't talk about the downside of that, you know, because they don't talk about that part. Same thing in like South Korea. You know, they just constantly are on you. Everybody don't respond well to that. But, you know, some people do. You know, so to each their own. They can run their country how they run it. But I'm glad they don't run it like that over here, because I can't do it. So appreciate everybody for coming through. We have 57. So I want to really encourage you. I'm not against the 8 to 10%. I'm not against the 12%. I'm for it. Some return is better than zero. But I want to really get you to understand you have to change a lot of times about your psychology to make more money. Then that can impact your expectation of the return on the capital. We have an environment to where the fund managers are convincing you that you should just take average returns because that's what makes money for them. But it may not necessarily be best for you. So I would encourage you to speak with somebody that looks to understand your psychology and how you make your money and how you got to where you're at. Because your pathway to become successful may be different than somebody else, which could tie into who you are as a person. And that could impact your expectation on your returns on capital, right? So I hope you got some value from it. David W. Williams, also known as Diamond Dave. I'll talk to you later.